Hi, hello everyone. Good afternoon. Hope you have your lunch. If you're at this session, then like me, you want to know more about what the IPO prospects are like in the near term, and what it means for the startup companies that you have invested in, what it means for the companies that you have founded. My name is Wei Sheng. I'm a partner at Qualgrow. We are a venture fund based in Singapore. We invest across Southeast Asia, and we had done one IPO in Japan in the past. We're preparing for 2 more listings in the US. So I personally am very invested in this session. Whether you're an investor or a founder or a tech executive, the public markets is an important topic for us to discuss. And luckily today, we have 2 very well-qualified professionals to give us their points of view. First, we have Tom Abbott, who represents the London Stock Exchange, and also we have Raj Kapoor, who founded Smart Karma. So Tom, would you please introduce yourself and tell us a little bit more about what the London Stock Exchange is doing?
Sure. Thanks, Wei Sheng. My name's Tom Abbott, with the Exchange now for coming up to a decade, which has flown by, but based in Singapore for the group. We are a very internationally focused exchange with about 36% of the companies listed on our market international in nature. So my role is very much to work with those from across the Asia Pacific that are already listed and make sure they're able to make the most of their listing, as well as speaking to people such as yourself, the investors and the shareholders in private companies, or even indeed already listed companies that might want to dual list into London, and tell them what London can offer and what makes sense.
Good. Raj, over to you.
Thanks, Wei Sheng. I'm Raj Kapoor. I am the CEO and co-founder of Smart Karma. We are an investment intelligence platform. We serve asset managers, we serve investment banks, and we also work very closely with exchanges. The Singapore Exchange is also one of our shareholders. I've been very involved in the equity capital market space for pretty much most of my career. And it's quite exciting to see several millions, if not billions of dollars of new market value that's been created in the region. And now I think we're moving from value creation to value crystallization. And that's where public markets become important, if not essential, and happy to share my thoughts.
I think let's start off with a little bit of a recent look back. Can you hear me? Okay, good. Let's start off with a bit of a recent look back. What has happened in the last 12 to 18 months in the public markets? If you could give us a broad level overview of what has happened, what are some interesting developments, or revelations, in fact, in the public markets, both in Southeast Asia, as well as what you see overseas in London, or perhaps in the US?
Happy to kick it off. Actually, the last 18 months have been a very quiet period for public markets globally, and certainly also in Southeast Asia and APAC. I think Asia as a whole has been very impacted by the slowdown in China, both the economy as well as the public markets, and that has seen capital sort of retracing. Of course, the bright spot in public markets globally has been very narrow and crowded around large tech companies, which are very big generators of cash flow. But the result of all of this has been a reset of focus from investors, from companies, as well as also a reframing of expectations going forward. So what we notice now as we speak to regulators, as we speak to companies, and as we speak to investors is that there is a much better realization of what unit economics should be in order to be considered mature and public ready. Also, there is a much better realization that the IPO is not the end of the journey. You don't forget the business. It doesn't disappear when it IPOs, but it's the start of the next leg of the journey. So having the right valuations, the right unit economics is crucial to the endurance of these companies going forward. And I think the last 18 months has managed to drill that message home.
That's a good reminder that the IPO is not the end of the end of the journey. Something even as investors sometimes we tend to forget, right, Tom?
No, I definitely echo that. I think the past 2023 particularly quite tough, really quite quiet markets. But just in the more sort of near term, we are sort of seeing that inflection point. One of those first signals often with the public markets is the follow-on activity. So this year, by July in London, we'd already raised as much equity as we did the whole of last year. And that's across all exchanges everywhere, where it's been really concentrated in that follow-on activity and companies that are already listed being able to make the most of that. But normally that's a pretty good sign that, as you say, as companies are starting to reset, investors resetting their expectations, that there's activity to come. We're seeing a lot of companies, looking from this region and everywhere, sort of looking at that step, being much better prepared, and having realized what that reset looks like. The companies that have squeaked through, we've had an IPO this morning in London, which was a nice bit of luck for me, sitting here. But that's a company that's been looking at going public for probably the past 3 years, realistically. Didn't quite make the window in 2021, probably quite glad about that looking back. But now has been able to prepare, really understand exactly what all of those steps are to get there and really set those investor expectations. And I think trading up sort of 5% this morning already.
Nice. Just one tiny bit to add there. I think there's also quite a bit of change that has happened on the regulatory side. Tom, I'm sure you can talk about the FCA, the UK side, but even in Asia, we're noticing several regulators announce very clear policies to revitalize equity markets. Just to share some examples, Japan launched its new stewardship code about 2 years ago, and that has resulted in a big re-rating of the entire equity market. And the valuations have come up, which makes it easier for private companies to list at the right market cap, right? We've seen that being followed now in South Korea. Just last month, South Korea launched the Value Up program, which again gets public markets re-rated to a level where it's interesting and actually possible for good, successful listings of companies. I think closer to home, we know Singapore has already announced the setup of a review committee, and they're working on several policies to attract issuers and also to just generally improve the health of companies that are already listed.
Yeah. And I think later on, I want to ask more about this topic, which is what kind of new developments should we expect or should we advocate for in the local markets here? But next, I want to ask a question that's more sort of relatable to Southeast Asia, right? In your opinion, how prepared are Southeast Asian technology companies? How prepared are they for IPOs in the current environment? It's a very broad question, but are there any sort of important considerations before they think about listing?
I think, I've actually been speaking to some of the founders of the more mature companies, private companies. We've had some roundtables in Singapore, also chaired by the Deputy Prime Minister of Singapore that I was fortunate enough to be part of. I had a chance to catch up with some of the founders here in Jakarta as well this week. I would say two things. First is, a lot of these companies have now set up IPO review committees, which means there is a sense of preparedness in terms of understanding of what entails an IPO process, right? And I think they're also more prepared in terms of engaging with advisors, having good consensus and alignment between existing shareholders and potential new shareholders of what valuations would be accepted by the market. So I think that's the first thing. I think the second thing also from a preparedness standpoint is they have, fingers crossed, but I think they have learned some key lessons from the listings that happened in the last 4 to 5 years. We saw examples of companies that went and listed in the US only to realize that they were orphaned and they had to privatize and come back. They've also seen examples of how that can be a very unfortunate instance for certain companies. They've also seen examples of listing with the wrong valuations and what that does to follow-on performance and the ability to raise future capital. So I think that's the two-pronged preparedness. Preparedness on the process and preparedness in terms of lessons learned.
Thanks.
Just to sort of add on, I think preparation is key. I think a realization that you might see those investment bankers' orders as timelines where it's 6 months out, but realistically these are 18-month, 2-year projects with your IPO committees putting all of that together. I think viewing it as an opportunity to get all of those efficiencies and corporate governance piece as part of your value, and people and companies really getting ready to see that. I think to your point, realizing that maybe the new investors that you're getting in, having those discussions early, in the UK, we've got a pretty strong emerging market investor base. You know, I'm not one to say that we're going to drag every company from here over. It has to make sense, whether it's the right EM story, it's a sector that London understands well. But that process and that point where you need to go and meet the investors early on, it can be a little bit of a rigmarole in the US and be promised everything. I think you get some really realistic feedback, be that in the region, in Australia, in Japan, and in London, and that will get you better prepared for that process.
But, you know, just sobering thought, I also feel that founders, as well as some of the private market shareholders, they actually don't fully understand how public markets work. So one of the realizations I've had from conversations with such founders over the last 2 to 3 months is there's a really big gap in information and learning about what are benchmarks, what are indices, how do passive funds allocate to these benchmarks, what is the importance of choosing the right benchmark, why certain benchmarks absolutely don't make sense for certain companies. And I feel that nobody's really educating the founders on that. The founders are way too busy with their businesses, or perhaps just what the valuation should be. But I think it's those finer nuances that still need to be learned.
I feel like, Raghav, you were looking a lot at me when you were talking about that. No, surely is I think everybody from founders to investors and everybody in the ecosystem got to be better at, you know, understanding what are the mechanics that can make a successful IPO. Just empirically, just from my own understanding, do you see more founders gravitating towards local markets to list in the IPO, you know, preparation, or is it more towards is there a preference for one or the other?
You know, the most fascinating part of the story is that there is no local market for a lot of these businesses because they are cross-border businesses. You know, I mean, I think people were talking about Gojek earlier, or GoTo, sorry, I should say. They operate in multiple markets, right? You know, a lot of the platforms that are ready now to list have the same phenomena. They've expanded beyond a single country. So the question becomes, if you're a cross-country regional platform, what's the right destination? It's not so straightforward. Do you list closest to where you generate most revenue from? Do you list yourself closest to where the biggest pools of capital for you are going to be? Or do you list somewhere where there is a distinct market positioning that matches you? So just to drive the point home, right? If you're a REIT today in the region, you will probably consider Singapore as your top choice. Why? Because 15 years ago, Singapore had a first mover advantage at pushing out a good REIT code. They did a lot of marketing around it. They had a first mover advantage, and they captured that market positioning, right? So now with some of the companies that are getting ready, I think that there's a gap there, which, you know, I don't think too many countries or bourses have captured the imagination of the companies from a distinct market positioning standpoint.
I think that's fair. I think just anecdotally, I was talking to one of the bulge bracket banks from the US the other week at their team in Singapore, and they had 5 companies doing sort of early look meetings, meeting investors in 5 different jurisdictions in the same week. You know, obviously a little bit biased, but you know, I think in London, you know, we've seen Vietnamese investment trusts that are listed in London that have really performed really well, so a real sort of interest. I think more traditional economy companies, MP Evans and the like, that have done that. And some of our rule changes have meant that some of those stereotypes about the London market, where we are quite sort of traditional real economy focused, are very much shifting, where we'll see more of the tech companies from UK, Europe going into our major indices. And by the way, to your point on the index inclusion, as an international business in a developed, FTSE developed market, as we call it, with a 25% free float, you'll be eligible for UK FTSE all-share inclusion, which can be a huge bit of passive investment coming into you as a company. And I know, you know, some of the pension funds in Australia will be able to claim some of those numbers. But yeah, it makes a massive difference in terms of being able to get interest at a smaller scale, especially compared to perhaps the US.
Yeah. One thing that I'll say is that I have very high conviction and a strong thesis that in the very near future, it absolutely won't matter where you're listed eventually, because you know your stock will probably trade 24 hours a day. It'll be settled on multiple bourses. And I think the sort of medium-term outlook is a much more homogeneous look across listing destinations. However, where you start your journey is extremely important because you want to be able to capture the imaginations and interest of investors who will value you appropriately and also have a very deep understanding of what is the growth trajectory of your business. You know, if you go and list in the wrong place where they don't even understand how your market operates, how the regulation works, what your growth is going to look like, then you will face a problem where few quarters into your financial reporting and earnings, you'll be sort of chewed and spat out, for lack of a better word. And then it's very hard to reverse course.
And along that line of thought, if I switch lens a little bit to think about how the London Stock Exchange, for example, would look at Southeast Asian companies, what are some, thoughts that they might have or conceptions that they might have about Southeast Asian tech companies listings?
I think there is that strong emerging market investor base. I think, when we've looked at some of the deals that have gone to the US, actually some of those first funds in there have been UK, London-based funds. But that's not to say it's perfect. And I think, to go back to the earlier point about investor engagement, you will have to, if you're an ag tech business from Indonesia, you'll have to explain exactly what that looks like and make sure that they get the overall model and so on. The one thing I would say is, your point to global businesses, you look at the FTSE 100, 75% of the revenues are outside of UK and Europe. It's very global in nature and investors that appreciate that. So I think an understanding, certainly for companies at scale, where they'll become a bit more of a must-own stock in a UK context. And even at the smaller end, we have a growth market that supported those.
Got it. And Raghav, you have been very involved in some of the discussions with SVCA, right, the Singapore Venture Capital Associations. What are some of the developments that, we talked about this earlier, I think you alluded to this, what are some of the developments that would enable Southeast Asian public markets or Singapore or Indonesia to favor technology listings? Because I don't think that that's something that's very forthcoming right now. Okay,
maybe I'll share 3 key points here. I think the first is that there is now a very, I think there's a very deep-rooted understanding now that something needs to be done to enable that move from value creation to crystallization. And I think the first thing in that direction is the ability to create dedicated pools of capital that understand innovation, that understand how to value innovation, and make those available for listings in and around Singapore, at least, with the possibility of great stock connects with LSE or ASX and so forth, right? So I think there are concerted efforts in that direction to create developmental pools of capital, because those same developmental pools of capital were available to create the VC and PE ecosystem 10, 15 years ago. Maria from Tech in Asia was chatting with us 2 nights ago about, hey, what did the ecosystem look like 10 years ago? So I think governments here put in quite a lot of effort to create that ecosystem. So I think similar efforts are now being discussed to enable that crossover from private to public. So that's number one. I think the second thing is there's also great realization now that these companies don't have listed comparables. If you look at e-fisheries, as you were mentioning, how many other e-fisheries exist in this part of the world? Probably 0. So it's very hard for the founders of the company to explain their business and explain why it should trade on a certain valuation without there being a good research ecosystem. So I think there's concerted efforts, and I know the UK is certainly working in that direction too, to create a much better research and data ecosystem around private markets. I think it's an essential part of the digital infrastructure that's required for such listings to succeed. So I think those are 2 important points. And I think the last thing, it's a thing that everybody ignores, but I think it's super important, is putting founders first. So understanding the motivations of the founders of these companies and what do they want to do with their lives going forward. As I said, the IPO is not the end. It's just the start of the next leg.
I have a follow-up question, but maybe I'll ask Tom something else so you can think about that. And the follow-up question is more around, Japan and Korea has a quite vibrant listing market for the local tech companies in Japan as well as Korea. What do you think they have done right? What policies have they done in their ecosystem to get things to that level of sophistication? But first, I'd like to ask Tom another question first. What are some of the things that the LSEG, the London Stock Exchange, has been doing well to encourage more activity on the public markets?
Sure. I do think we came from a relative position of strength. I mentioned we sort of had total equity capital raise sort of third globally this year, and we've consistently been around that sort of point. I think we've had quite a balanced view when it comes to that balance between getting corporate governance and the associated costs around that, as well as sustainability reporting, versus what you're really getting in terms of that valuation and the capital that you're receiving. For our smaller growth market, we've had a system that enables companies at a really early stage to be able to attract capital and grow and move through those stages and come back to market and raise follow-on and grow. So even as we had a company called Keyword Studios that came as a £30 million business, now, recently unfortunately bought out, but rose to be a £2 billion sterling business. But that ability to be able to come back to market very, very quickly really sort of supported companies that were quite quick. What we've now done in the meantime is, we've realized that our premium, we used to have a main market that was split between different stages and so on, was a little bit confusing. So we've simplified that. Some of the extra rules that were needed around getting shareholder votes on acquisitions and so on, all of that's gone. So we're just trying to simplify things, and we've probably ended up with a system that is one of the most straightforward to list on globally. Again, not trying to say that it's going to work for everyone, but I think straight away up front, there's no sort of concerns about profit levels or things. It's about suitability and being ready, and the ambition, to your point, of the founder and whether they want to be a public company and take that next step.
Okay. So to Japan and Korea, right? Okay, so I think for any market to do this successfully, you need four things. The very first thing is, do you have the right regulatory framework and the governance structure, which makes it comfortable for investors to come there, number one. Number two, you need good exchange trading infrastructure, like just basic hygiene, right? Number three, you need captive institutional liquidity. Let me unpack that. Basically, you need funds, fund managers and funds who are captive to that market. Like that's all they do. Their day job is to invest in companies that are listed there. And the fourth thing is you need active retail investor participation. You need the man on the ground to also feel excited about investing. I think if any of those pieces is not fully developed, you're not going to see a healthy, great outcome. So what did Japan do? So Japan has captive pension funds, GPIF being the big one. That's all they do. They only invest in Japan. The second thing is they have a structure called NISA, which is a retail account. Whatever money you put into that, you can invest it into the stock market. I think there's a tax shelter around it as well. But basically, it mobilizes personal household savings into the equity market. South Korea, similar stuff. They've got local pension funds that actively invest in that market and in a captive manner, and active retail participation. And of course, both these markets also have very good trading infrastructure and the regulatory framework that supports everything.
Do you want to add something?
No, I was just going to say, yeah, Japan, the sort of NISA model, very much based on the ISA in the UK, and I guess that pension piece is interesting. Part of the reforms that we've seen in London, look, we have suffered from the volume of UK pension capital, despite being the second largest total pot globally, not necessarily going into UK equities. I don't think we're going to go as far as saying that's what it must do, but there's now disclosure around how much of that's going there. And there's also been a push to get it actually going into private capitals, so that companies earlier on in their growth journey will have that sway of looking at London as a destination.
Okay. I have a question that's probably going to, let's look back at this in 2 to 3 years, but what is 1 or 2 predictions that you might have about the public markets, whether it's the Southeast Asian markets or globally, for the next 2 to 3 years? How would it shape out for IPOs, for example?
I think there is great convergence happening between public and private markets. So that's my first prediction. This thing about companies want to stay private for longer and all of that, I don't think we're going to say any of that stuff in 3 to 4 years. The reason is there's no difference. private exchanges are being set up to allow stock of private companies to trade. What's the difference then, right? And at the same time, you don't have infinite private capital available that will fund at all costs, right? The ecosystem has matured up to unit economics and all of those sorts of things. So I think public-private convergence is my first prediction. Tom, do you want to go next?
I hate it to be an agree fest, but it's a bit of a love-hate relationship between public and private, but functioning private markets need functioning public markets. So it's a cycle that we'll see. So I very much be in agreement on that.
Yeah. I think the other thing that's going to happen, which is potentially quite exciting, is I spoke about Stock Connect programs between different exchanges. It's really exciting, but we've already taken some good steps towards it here in ASEAN, in Southeast Asia. So the ASEAN exchanges have embarked on a DLC or a dual listing framework, and we've already seen some good early successes. So there are some Thai companies that are listed on the SGX, the Singapore Exchange. There are some Singapore companies that are listed in Thailand, and I think they're piloting this, and soon they will open this up. So I think what that does is that, especially for the companies that operate cross-border, cross-country, the local populations can invest easily in them, irrespective of where their primary listing destination is. So I think you will see those sorts of programs here. Europe, of course, has done it for many years now.
I completely agree. I mean, one of the nice things about the UK and sort of common law in Singapore or Australia or other places is we've always been a hub for dual listings. I think 17% of the companies are dual listed, and it works really well, especially in maybe a world where companies have been grown up here but might not have the right analysts here. That sort of link, I think, could make complete sense. Definitely something we'll see. And on the public-private piece, a bit ambitious, but we had a new CEO come into the LSE about 4 years ago, and she came up in front of a room full of more sort of pension funds and investors and said, we want to be the first exchange that is agnostic as to whether a company is public or private. Very much to your point, we want to be able to offer platforms. What we're really doing is trying to connect, as an exchange, connect investors, capital, with companies. So we're doing quite a few exciting things in that space, working with UK government on a crossover market, which will hopefully give some of those stages companies aren't quite ready to be fully public, don't feel they've got that step, but give them an opportunity for some of the earlier stage investors, employees to get some, a little bit of liquidity and options to get out.
And the last point from my side is that I think most exchanges in this part of the world would make it easier for earlier stage companies to list. So your journey as a public company can begin much earlier. Maybe the level of disclosure or overheads required will be much, much lower as well. So I think soon you'll probably see VCs who invest in publicly listed early stage companies. Because why not, right?
Indeed, I think there will be a real innovation in our ecosystem. Cool. Just to wrap, I think we have about 2 minutes left, but I would like each of you to, there's a lot of founders in the room today. What is one advice that you would tell founders about raising money from the capital markets, and talk about this in terms of the strategy to achieve it, but also the mentality that founders should have when it comes to trying to go for a listing?
I think preparation is key. I think we've touched upon that a lot at the beginning, talking to the investors, realizing those are going to be the relationships that you're going to have to build. I think Raj's point on realizing that the IPO itself is just the beginning. We also sort of have internally, I think we've even got a slide that says an IPO is for life, not just for Christmas. So making sure that you've got that mentality, being aware that as a public company, there is going to be greater scrutiny. One of the weaknesses I would say about London is that wider press scrutiny and things. It's a lot. You have to be tough to be able to take that. Potentially have to consider, the mantra is under promise, over deliver. Just make sure you hit those results and keep on growing.
Raghav, would you wrap it up first?
Okay, so I have a very, very practical advice for companies who have hit Series B and beyond. Start to get somebody or yourself to start publishing investment research on your company. I'll explain this, right? If we have a product we're a startup, we make a product, we make a service. Before we sell it, we have to market it. The marketing informs what the sales tactics should be, right? And a lot of us understand the importance of inbound marketing as well now, right? Investment research serves that purpose. You're about to list your stock. You're selling your stock now to a much larger audience. Yeah. Well, before you start the sales process, start the marketing process. And the sooner you start it, the more feedback and intelligence you're going to get back. Yeah. And I think some of the companies have not realized just how easy it is to do that. So, like, you know, on Smart Karma now, we've got 3,000 investor relations teams registered and onboarded. Even these are already publicly listed companies. A lot of them have no research. In fact, 80% of all listed companies across emerging markets have no research. So how are you going to sell your stock the next time? So I think just start doing that. It's a very simple, inexpensive, practical step.
Indeed, it's very practical advice from Raghav as well as Tom today. Thank you. I think we have come to the close of the session. Let's wrap it up.
Thank you.
Thanks, Wish.